Yes.
Very good. Okay, so thank you all for joining today's ECB in Focus webinar series. Today our speaker is Christiane Baumeister, who is a professor of economics at the University of Notre Dame. And although Christiane currently lives and works in the United States, she's a European citizen originally from Germany, with a PhD in economics from Ghent University in Belgium, and I understand she speaks 4 European languages fluently. She also currently serves as visiting research professor at the Bundesbank. Christiane will talk to us about oil prices and inflation. This is, of course, a topic that greatly occupies the minds of central banks today. This month, German inflation rose to 7.3% on an annual basis, hitting a 40-year high. And our president has recently warned of prolonged supply shocks, in part driven by higher oil and gas prices. Christiane is an ideal speaker on the topic. She's one of the world's leading scholars on the dynamics of energy markets and has for many years studied the implications of oil supply shocks for the economy. Christiane has published widely on this topic in the top economics journals such as the American Economic Review. The format of today's 1-hour webinar is as follows. Christiane will start with a presentation for about 45 minutes, and that will be followed by 15 minutes questions from you and answers by Christiane. I have the pleasure of collecting your questions via the chat function. And with that, Christiane, the floor is yours.
Okay, well, let me start by sharing my screen. Okay, well, thanks so much, Luc, for the invitation and the introduction. It's a pleasure to be here today to talk about oil prices and inflation. The Russian invasion of Ukraine has often been described as a watershed event in that it opens the door for the possibility of economic decoupling and a reversal of globalization with disruptions to trade and possibly a deceleration of the recovery from the pandemic. Now, in other areas, the Ukrainian invasion has reinforced trends that were actually already present before the outbreak of the conflict. And here I'm thinking in particular about developments of energy prices and consumer prices. And in fact, what I want to do today is to take a close look at developments in oil markets before the invasion of Ukraine and analyze the drivers of the most recent fluctuations in the price of oil in order to put current events into context. Then I want to take a look ahead and ask, well, what future developments in oil markets might look like. And against this background, I then will turn to the macroeconomic implications, in particular to inflation. So I'll start with a graph of the developments of the price of Brent crude oil, where you see that before the onset of the pandemic, which is marked here with the dashed line, oil prices have been fluctuating between $60 to $80 a barrel. Now, when the pandemic hit and the world basically went into lockdown in March 2020, oil prices collapsed and reached a low of $20 per barrel. Since then, they have been on a relatively steady and continuous upward trajectory, reaching levels as before the pandemic. Now, the second line here indicates December 2021, when tensions between Russia and Ukraine first became apparent, and there was the possibility of, or kind of like the possibility of a war became sort of apparent. Now, on the day of the invasion of Ukraine on February 24, oil prices jumped above $100 per barrel and have been there more or less ever since. So this red part of the price developments here is the average for March up until March 23rd, which is the latest data point that I had available. And as it was announced in the news this morning, so the Brent price is at around $109 per barrel, which means that we're back at the level of the beginning of March. So probably this price will come out on average a little bit lower than what I show here. But what we really want to do is to understand this price recovery even before the onset of the Ukrainian conflict. And so in order to do that, let's take a look at the development of market fundamentals. So you can clearly see that as the pandemic hit, demand collapsed sharply. So here I show you fuel consumption worldwide, and you see that there was a very sharp decrease. Now, in the early stages of the pandemic, there was a lot of speculation whether we'd ever get back to pre-COVID consumption levels. And the idea was that such a strong reduction in consumption would propel the transition to renewables. But with hindsight, we see that there was actually a very strong rebound. Consumption jumped back, and by now is back to pre-pandemic levels, which is indicated here with the black line. Now, what happened on the production side? Well, also production fell sharply at around the same time, namely when in April 2020, OPEC Plus agreed to reduce global output by about 10 million barrels per day, which roughly amounts to 10% of global production. Now, oil production has also been climbing up again, but the recovery here has been more gradual and only partially completed. So as you can see, the oil production is not back to pre-pandemic levels, and so supply is basically lagging behind demand. And it is this supply-demand imbalance that led to a tight market even before the invasion of Ukraine, and and obviously the price increase that I showed you in the first slide. Now, this is suggestive evidence of what has been going on in markets, but it would be really useful to determine the contribution of supply side versus demand side factors in this recent upward trajectory of oil prices. And in order to do that, so to quantify the relative importance of supply versus demand factors, I'm going to use the model of the global oil market that I developed with Jim Hamilton a couple of years back, which is estimated based on monthly data of the global production of crude oil, which obviously captures the supply side of the market, the change in crude oil inventories, which if you combine that with the production, you get the demand side of the market, because production plus changes in oil stocks tells you how much oil is consumed. It also includes the real price of Brent crude oil and world industrial production as a measure of economic activity. Now, just ideas of what that model roughly looks like. here are the two key structural equations among the four equations of that model. So the first one is the supply equation that describes the behavior of oil producers, where Q is the amount of oil pumped out of the ground, P is the real price of oil, and alpha here is the short-run price elasticity of supply. Then we also have some lags of fundamental determinants to capture the dynamics. And this U1 here is an unexpected change in supply, so an oil supply shock. Now, on the demand side, as I said before, if you take the quantity of oil produced minus the change in inventories, you know how much oil is consumed in any given month, which is influenced by developments of the price and by how well the global economy is doing, which is captured here by Y, which stands for industrial production. So these two coefficients, these two betas here, are the income and the price elasticity of demand. And then we have an oil consumption demand shock here. Now, we can use this model in order to understand and disentangle the drivers of oil price fluctuations. Now, going back to or zooming into the period between the start of the pandemic and when tensions between Russia and Ukraine arose, we can basically divide that up into two periods. So between April, when the oil price reached a trough of slightly below $20 a barrel, and in August, when it was back to slightly above $40 per barrel, we can quantify what triggered this increase in the price. And so this 88% price increase in logarithmic terms is accounted for by supply shocks for over half. So that means the supply cuts of OPEC Plus that were put in action during that period lifted the oil price off its floor and explains over half of that first part of the price recovery. Now, the second period here of the price recovery from another trough at around $40 back to above $80 per barrel, which amounts to a 67% price increase in logarithmic terms, is to 84% due to demand factor. And that is in line with the observation, basically, that there was a lot of pent-up demand in the system. So people were basically catching up on the demand that they couldn't effectuate during the lockdowns during the pandemic. And that explains the second part of the price recovery. Now, in order to understand both past, but most importantly, future price developments, it's important to take a look at the structure of the oil market. As I already pointed out, the oil market is a global market. And the reason for that is that oil can be easily shipped across locations, so there's a lot of room for arbitrage, which is not the case, for example, in natural gas, which is also at the heart of many discussions about energy these days. The natural gas market is a fragmented market because it is so much harder to ship gas And so that results in local pockets of natural gas markets. Now, the consequence of oil being traded in a global market is that whatever happens to oil production in one country or one part of the world affects the price everywhere. And there are basically three key oil producers right now that account for a large share of world production. And these are the United States, which right now is the number one oil producer and accounts on average during, based on data for 2021, for 11 million barrels per day. Then we have Saudi Arabia that produced 9 million barrels per day. And then there's, of course, Russia, which right now is the second largest producer with an average of 10 million barrels per day. And in fact, here you can also see the development of the share of oil production for these three major oil producers over the last two decades. And you see there's always a little bit of change happening with first and second. Right now, this is the kind of like the situation in the oil market. Now, the question that has been on our minds, I guess, since the beginning of the conflict was really what would happen if there were a significant reduction in Russian oil production. And the fact that that has been on a lot of people's minds was basically obvious in the high volatility of oil prices during March, where the oil market really grappled with understanding or kind of like showing the concerns about whether the supplies from Russia will continue to reach the market, or how likely the possibility of of widespread sanctions might be. Now, one way to answer this question of what would happen to oil prices in the case of a decrease in exports from Russia is to rely on historical episodes and basically replay history. So there are two events historically that have been likened to what is currently happening in Ukraine. The first one is the first Gulf War that started with the Iraqi invasion of Kuwait in August 1990. But actually, the interesting parallel with current events in Ukraine or in the run-up to the conflict was actually that Iraq deployed troops along its border with Kuwait already in July 1990, very much like Russia has done with Ukraine, creating a really massive military buildup. And so what we're going to do is to use the oil supply shock sequence that developed basically from July 1990 all the way up to February 1991, when the end of Operation Desert Storm basically finished the conflict by liberating Kuwait. Now, in this case, the initial disruption in oil supply amounted to 6.9% of global production. So just to give you a little bit of a sense what those numbers look like. Now, the second historical precedent that we can use to draw parallels with the current situation is the Iranian Revolution. And again, we're going to take the oil supply shock sequence estimated from the model for the period January 1978, when tensions in Iran first began with protests and when there was really a sign that things until December 1978, when the Shah handed over power and afterwards left the country. So in this case, the initial disruption was around 3.3% of global oil production. So this is one way in which we can try to get a sense of what to expect for oil prices against the background of the Ukrainian invasion going forward. Another possibility, an alternative approach, is to basically design a possible path for supply reductions that would result from sanctions imposed by different parts of the world. So here I show you a breakdown of exports from Russia by destination. And as you can see, of the close to 5 million barrels per day that Russia exports, about half goes to Europe. Now, the first hypothetical scenario that I want to propose is that Europe stops all imports in April, which would amount to a decrease of in global oil availability of 2.3 million barrels per day, which is about 3% of global production. Okay, so the question is whether that would be due to sanctions or whether Russia might cut Europe off from supplies. But this is the thought experiment here, that we would lose 3% of global production. Now, things could also get worse, that after that, all other remaining countries to which Russia exports, except for China and Belarus, which are on more on the side of Russia, would also basically stop importing Russian oil. And that would lead to an additional loss of 0.9% of global production, which I term here as the worst case scenario, because that means basically from this chart here, all the production to countries other than China and Belarus would be taken out of the picture. Now, in order to account also for the fact that Russia plays an important role in exporting natural gas, which we cannot directly model here, is to assume a lower elasticity of demand in the current environment compared to past experience. So this is an indirect way to account for the limited substitutability with other energy sources due to the fact that Russia is not only an important exporter of oil, but also of natural gas. So in these two sanction scenarios, I also gonna assume that buyers now are only half as responsive as before in replacing basically, or in adjusting their oil consumption. Okay, so what are the implications of these four scenarios for the price? Well, here they are. So here I show you simulated price paths for Brent over the next 12 months. So here is the price for March 2022, and then these are the price paths under the various scenarios. So in black, are the scenarios inspired by historical episodes, by historical events, and the red ones are the hypothetical sanction scenario. And what you can see is that in what I termed the worst case scenario, oil prices could reach a peak of about $170 per barrel before kind of like showing some decrease again, whereas the two historical episodes are implying slightly lower oil price paths. But broadly speaking, the oil price based on these point estimates, point paths simulating the model forward, range somewhere between $135 and $170 per barrel. Of course, if you account for the uncertainty around that, you would get a slightly larger range here. Now, that might seem kind of like very drastic to some extent, and it undoubtedly is if we think about the possible implications here. But let's put these possible price paths into historical context by looking at the Brent price developments over the course of history. And there we see, yes, they are high, but they are not sort of out of out of context in a way. So they're kind of like within historical experience, even though obviously they are kind of like on the upper end of things. Now, the question is, of course, if any of these scenarios were to come to pass, well, could other oil producers make up for the lost exports? And one obvious candidate here is obviously the US, which currently is the number one producer in the world. Now, here I show you the developments of US crude oil production. And as you can see, relative to the pre-pandemic levels, where US production was close to 30 million barrels per day, the US is still about 1 million barrel per day short. So it has not recovered to pre-pandemic levels. And here is actually the projected path that the US Energy Information Administration sees over the next 2 years. And so you see that the projection is basically that only at the beginning of 2023, US crude oil production will have recovered to pre-pandemic levels. Now, the question is, well, what are the reasons for this relatively slow recovery? We know that historically, US shale oil production has been able to ramp up in a short time span. And so the question is, well, why doesn't that seem to be possible right now? And the reason are basically, on the one hand, physical constraints, and on the other hand, corporate demands that have slowed down that responsiveness of the US oil sector. Now, on the physical side, a lot of oil companies actually went bankrupt when oil prices collapsed in April 2020, and that means that oil wells were left idle since the downturn. And that means that it's very difficult to reverse these shut-ins due to this prolonged period of inactivity. Now, there are other that we have also experienced in other sectors, namely supply chain disruptions and labor shortage. On the supply side, the lack of the availability of fracking sand, since also there many suppliers went bankrupt as a result of COVID, so it's not easy to basically have the key ingredients to get these wells going again. Also, drilling equipment is scarce. So the oil industry faces a number of challenges really in procuring the necessary materials in order to ramp up production. And similarly on the workforce side, so a lot of workers left the oil industry, and it's very hard to basically bring them back into the sector, which causes additional bottlenecks here. Now, another important factor are corporate barriers. So the oil industry has been facing a lot of pressure from shareholders to increase returns and cash, well, returning cash to the investors, and that's one of the main reasons for the production restraint that oil companies have been exercising. So they are really intended to maintain capital discipline in order to satisfy the investors. And the reason is basically that the sector have not generated returns even before the pandemic satisfactorily. So now this has become much more a binding constraint. Now, there's obviously also a lot of uncertainty about the long-term perspective of the industry as a whole in light of the green transition and climate policies, which also does not make investors inclined to make longer-term investments. And there are also ESG factors that basically are playing a role in investors' considerations because there has been a push to decarbonize their portfolios. So these are all reasons why there's still slow growth in U.S. oil production, even though now, of course, the calls on the industry get louder and louder to increase production again. Now, the question is, well, can we do something by providing incentives through policy measures? Here it's important to know that only 1/4 of oil wells are actually on federal land, so where the government can basically, by issuing drilling permits, influence to some extent or foster production. Whereas 3/4 is on private land, and that means it is ruled by Wall Street. So the question is kind of like whether policies can be put in place that also sort of help overcome some of these corporate barriers down the road. Now, here is some recent evidence from Texan oil production. So this is based on an energy survey that asks oil and gas executives about the current and future developments in the industry, and this business activity index seems to indicate that they see some improvement, but it still has to show up really in production. But there seems to be some light at the end of the tunnel. Now, Canada is another possible producer who has already promised to actually ramp up production. But the fact is that most of Canadian production is exported to the US. Now, given that the US already has banned Russian oil imports and needs to make up for the lost barrels, this is likely to come from Canada. And also here, if you look at the projection of the EIA, there doesn't seem to be a lot of expectation for production increases just yet. Now, of course, another prime suspect for making up for potentially lost Russian exports is OPEC. Now, also OPEC is still 2 million barrels per day short of its pre-pandemic production levels, and also here the projection is somewhat subdued. Now, there are actually only 2 OPEC members that potentially have sufficient spare capacity to ramp up production, and these are Saudi Arabia and the Emirates. The complication with Saudi Arabia right now is that it seems firmly committed to the OPEC plus production agreement to only gradually unwind the cuts that were put in place in response to the fallout of demand in the early stages of the pandemic. And so they seem to be committed to only increase production by 0.4 million barrels per day. Now, it will be interesting given that OPEC meets today and might renegotiate production quotas and trajectories. So it will be interesting to see when they make their announcement. Now, going back to Saudi Arabia specifically, they have faced also some recent attacks on their oil infrastructure. So there's also some uncertainty going forward with regard to stability in the region. And Saudi Arabia also has or the Saudi Arabian oil industry is also faced with some underinvestment for the past couple of years, which also is a drag on increasing production. Now, yet another complicating factor is that Russia is actually part of OPEC Plus since late 2016. And so the question is whether Saudi Arabia really will go against against Russia and increase or make up for potentially lost exports. Okay, so here is kind of like a summary picture of the overall activity in the oil industry. So rig counts tend to be a good indicator for the willingness to invest. And also here we see a steady increase after the trough of the pandemic, but also there we're not back to pre-pandemic overall activity in drilling. Okay. Now, maybe let me skip this in the interest of time and just go to the implications of all of this for consumer price inflation. Now, the first thing to note here is that households do not consume, obviously, crude oil directly, but refined products. So the first thing that we want to take a look at is the link between the price of crude oil and the price of gasoline at the pump, which is obviously the most visible one to consumers. And then we want to make a distinction between the direct effect and the indirect effect of oil supply shocks on inflation. So the direct effect is basically on the energy component in HICP itself, which currently is 9.5%. And then when it comes to the non-energy component, there are a number of indirect effects that in the way that oil supply shocks can show up there. It is via production costs of non-energy goods and services, second round effects that show up in inflation expectations and potential wage pressures, and then the aggregate demand response might have some deflationary effects even. Okay, so here is a graph of the weekly pass-through of oil prices to gasoline prices in the euro area. Now, about 2/3 of gasoline prices are taxes, which over time are relatively stable. So I'm going to focus here on the pre-tax price, where the most important component is the cost of crude oil. And what you can see here is that oil costs and the gasoline price without taxes actually move very much in sync, which means that both oil price increases and decreases are passed on by refiners and gasoline distributors to the consumer, because oftentimes there's this notion that refiners would keep that markup, but that does not markup stable and not pass on price decreases in the same way as price increases, but that does not seem to be the case. Now that means that we can basically take the crude oil price in order to study the pass-through without directly modeling the gasoline price empirically. And in fact, that's what I'm going to do next. So I augment the global oil market model that I used before to decompose the oil price movements with two measures of inflation, namely annual HICP inflation and market-based inflation expectations for the euro area. This has been done by in a paper by Asweit, Brundtland, and Cross for the US. So I'm basically taking their model and bring it to European data. So here is the effect of a 10% increase in the real price of oil that is triggered by an oil supply shock. And this is overall inflation. So you see that there is a gradual increase in HICP inflation that peaks at around 1 year after the shock and then gradually subsides. Now, when we look at inflation expectations, I use two measures. One is the market-based five-year forward rate, and one is a household. One is based on a household survey, and we know that kind of like expectations, depending on whether it's coming from market participants or from consumers, can be different. And in fact, that shows up in the results. So if we look at market-based inflation expectations, we see a relatively subdued response, but for households, the response is much stronger and longer lasting, probably because gasoline prices are so much more visible for households that they receive a greater weight when forming inflation expectations. So this is about an increase of 0.2% after a year. Now, what kind of like is the role of recent oil price developments for the surge in inflation? So here I'm doing a similar decomposition as I did before for the same periods during which we saw oil prices increase. So between October 2020 and 2021, annual HICP inflation increased by 4.25 percentage points, and 2.4 percentage points of that can be attributed to oil shocks, where the majority here is accounted for by oil demand shocks, in line with the story of the pent-up demand that was also pushing oil prices higher. Now, since October 2021, up until February, which is the latest observation that I have, inflation has climbed another 1.7 percentage points, of which 0.5 comes from oil supply and demand shocks. Now, if we use the scenarios of the oil sanctions that I showed you before, so then they imply that inflation would be between 0.5 and 0.9 percentage points higher over the next 12 months. So this shortfall in production or a shortfall in Russian exports that leads to the price path that I showed you before would consistently keep inflation but higher by this amount. Now, another interesting question is, to what extent does the environment in which the oil supply shock occurs matter for the transmission of the shock? And currently, obviously, we're in a highly geopolitically tense environment. And in order to model that, I use the geopolitical risk indicator of Caldara and Iacoviello in order to distinguish between periods of high and low geopolitical risk to see whether the effects of oil supply shocks on inflationary measures differ across these two regimes. And then I use the oil supply shock series of our global oil market model in a state-dependent local projection model that differentiates between these periods of high and low geopolitical risks. So here is the effect, again, of a 10% oil price increase due to an oil supply shock on overall inflation. And the black dotted line here is what I showed you before, which is the average effect over the entire period. But once we start distinguishing between high and low geopolitical risk regimes, we see that the effects are different. So the red line is the high geopolitical risk response, and you see that in such an environment, overall inflation rises much more steeply and to higher levels, whereas the blue line is sort of in normal times, in low geopolitical risk environments, and there the inflation response is more subdued. Now we can also take a look at various disaggregated measures here. The first one is to focus on the two components that tend to be excluded from core measures. So here is energy inflation, which is showing the direct response to oil price, or captures the direct response to oil price increases. And also here we see that the magnitudes are fairly different between the high and low geopolitical risk regimes, but even more importantly, for food inflation. So there it really matters to take into account the current state when studying the transmission of oil supply shocks. Now, the way in which oil supply shocks can affect food inflation is obviously due to the fact that in order to run agricultural equipment and distribute food products to the final consumers, you need oil. So both for production and transportation. Now, here's the response of core inflation. So to what extent the oil price increase passes through to other non-energy goods and services. And again, I would say the alarming evidence here is that this seems to be very persistent. So it takes some time in the high geopolitical risk regime for oil prices to make it through to inflation, but then it stays kind of like consistently higher. So even after 2 years, we don't see any reversal here. Now, we can also look at the effect on inflation for a specific segment, and here I look at car purchases because obviously cars and depend on oil, so there are higher operating costs of driving a car in the case that oil prices increase. And in the geopolitical low risk regime, we see an increase in those prices, which probably indicates that people buy maybe more fuel efficient cars. Again, what is more interesting is the high geopolitical risk regime, because here it seems that the uncertainty about the future availability of oil leads to postponing irreversible investments, or kind of like highly sticky investments, like the purchase of durables or of a car that are complementary with energy. So, and this is also some indication of a possible demand effect here showing up. Now, more specifically to speaking a little bit to the demand side effects, we can look at consumer confidence here, which is available at the monthly frequency, and I consider this here as a proxy for future spending. And not surprisingly, we see that consumer confidence in response to an oil supply shock decreases in the high geopolitical risk regime, whereas it doesn't have a significant effect in the low geopolitical risk regime. So I think I'm kind of like pretty much out of time. So let me just close with some thoughts. So oil markets are certainly one important area of current economic concerns, but by no means the only ones. So there are a number of additional sources from which inflationary pressures can derive that I haven't been able to touch upon, but I just want to briefly kind of like summarize here and then put on people's radars. Obviously, we have witnessed price surges also in a number of other commodity markets, where Russia also plays an important role as an exporter, which will add to the inflationary pressures that I just showed you for oil. We can also expect that as a result of the war, the supply chain issues that arose in the aftermath of the pandemic are going to be more prolonged, and there will be additional disruptions to trade, which will also be reflected in higher prices. Now, Europe also is having very ambitious plans now to become independent of Russian energy as quickly as possible, and that will require large changes in the capital stock and require investments in infrastructure, which of course can also lead to additional inflation. Now, before we open the floor for questions, I would like to wrap up with a more general thought, namely that despite all the economic worries and challenges that we're facing and that are on our minds and the minds of central bankers in particular, another thing that's obviously also on our minds and even more important is the the humanitarian disaster that is obviously happening in Ukraine right now. And so I want to stop or to finish with the question that Jim Hamilton asked a couple of days ago in one of his Econ Browser blog posts, namely, what can I do to help Ukraine? And he put up a couple of places here where each and every one of us can make financial contributions. And I, for one, have decided to basically donate the speaker's fee that the ECB generously offered to these three places. Thank you very much.
Thank you, Christiane, and also for putting some heart in the matter. Obviously, also as central bankers, we may come across heartless by approaching inflation from the perspective that we do, but we are as worried about the geopolitical situation as you are, and indeed at the ECB there are many similar initiatives to make a contribution. Now, I've received a number of questions from the floor. So just as I filled up the tank this morning at the gas station, it was the first time I paid more than 100 euros. I try to drive much less, so this was a long time ago that I did that. But so I guess one question that's on people's mind is, for how much longer will these prices stay so high? And what struck one of the members of the audience is that in most of your simulations, the oil prices peak and then taper off, but then quickly come down sort of in a 6 to 9 month interval. And so the question is simply, what is sort of what's the reason for that, and sort of in your modeling approach that leads to these prices again dropping over such a period?
It's basically determined mostly by the dynamics of the model, which kind of is taking its cues from historical precedent, right? So kind of like the model in a way knows that sort of there has to be coming an end sort of to these things at some point. Sense also that while it might not be possible to make up for the loss of exports in the short run, as I showed you, these other producers eventually might make up for whatever is lost from Russia, right? So this is basically the dynamics kicking in there, that over this 1 year horizon, so they peak about 6-7 months after taking out the production and keeping it off the market, right? So from Russia, but at some point, kind of like that. At that point, other producers will simply, increase their production and fill that void. I can't hear you, Luke. I see you're talking, but
Thank you. So another question is about the supply shock that you model, whether it could be more reactive than past regularity. So, I mean, we understand from what you showed us about the constraints in the US that it's very difficult to ramp up production, so this seems to be difficult. But have you considered also modeling more reactive patterns, or alternatively substitution from other energy sources that would?
Right. So, I mean, as I mentioned before, it's kind of like this can be accomplished only in an indirect way, right? So, by within that modeling framework, because of course it would be very nice if we could have multiple energy sources in one model, especially natural gas, which is sort of, the other hot spot in energy markets right now. But the fact that these markets are so localized makes it really hard to combine that. So that's why I thought a useful way of taking that into account is to basically say, given that not only oil, but all the energy sources in a way are in trouble right now, if we have to reduce demand because of limited availability, we have a harder time doing that, and that's captured by the elasticity of demand, which captures how sensitive, how much adjustment we can really make, how responsive we can be in terms of decreasing consumption. So it is an imperfect way, I agree, but it's sort of the best that you can do within this model framework. Now, to your more general point about basically how to design the scenarios, right? They're just suggestions, and they come kind of like from what I think is sensible. But of course, you could make other assumptions. You could also, the model lends itself to also say, okay, I think that I don't know, U.S. production within 3 months can lift or can make up for lost production. Now, today there will be an announcement by Joe Biden about another release from the Strategic Petroleum Reserve. You could also kind of like factor that in as kind of like a counteracting force. So, but it depends on how you want to design a realistic path here. Based on my information that I had at the time, this seemed a sensible first pass, but it's certainly not the only one. I think what is appealing here, though, is that we have a very clear, or we can very clearly describe what our assumptions are, because sometimes you see scenarios out there and people are talking, oh, the price can go to 200 barrels, $200 per barrel, but we don't really know what the underlying assumptions are. So.
Thank you. So we are running short of time, and I see still many questions. So let me just pick a final question that is close to monetary policy. So you showed this decomposition of the shock last year. Mainly, you subscribed it mainly to an oil demand shock, and today you talked a lot about supply shocks. So, of course, for monetary policy, it's very important to know what type of shock it is in terms of how we should react. So is it fair to conclude that you think that what we are living through today is mainly an oil supply shock? Or can you see ways in which also this indirect aggregate demand response would also become big, or in other ways we could end up with also a sizable oil demand shock?
Right, that's an excellent question. I mean, given that most of the discussion right now revolves around the oil sanctions, it seems logical to focus on oil supply shocks, because that would be a big disruption and a big decrease in the global availability of oil, right? So, but as you correctly pointed out, this does not mean that we're not also facing energy demand shocks, right? So this is kind of like one of the possible consequences of high prices, given that you mentioned before, how long will you still have to fill your gas tank for over 100 euros? So that kind of like the high prices will also lead to some reductions in demand. But again, given maybe limited replacements, right? So, I mean, if you still need to drive to work, you need to drive to work. So and you cannot kind of like, or you probably in the current environment might not easily switch to an electric vehicle or something, just given the overall uncertainty, I would say. And so yes, it will have some demand effects. Whether these will be the dominant ones, yeah, we will have to wait and see.
Well, thank you so much, Christiane, for that. And by the way, I've decided to bike to work from now on. But
That's another good
that's a
alternative.
small contribution. Very good. So we've run out of time. It was a pleasure hosting you. Thank you so much for doing this for us today. I know it was early for you over there. And thank you all for joining. And I hope to see you next time. Bye now,
It was my
Christiane.
pleasure. Thanks again.
Take care.
Bye.